Something unusual happened recently that most people completely missed. While silver prices were swinging wildly and the news was telling one story, something else entirely was happening behind the scenes. People were literally lining up around the block to buy physical silver while the price was supposedly crashing. That disconnect tells you everything you need to know about what's really going on. By the time we're done here, you'll understand why this might be one of the most important financial opportunities right now, and why the recent chaos in silver markets actually makes the case stronger, not weaker. Before we go any further, let me be crystal clear about something. Nothing here is financial advice. These are personal views and opinions about what's happening in the silver market based on research and analysis. Everyone needs to make their own decisions and do their own homework. What works for one person might not work for another. Now, let's get into why silver deserves serious attention right now. The recent price action in silver was absolutely wild. The price dropped significantly in a single day, the kind of move that makes headlines and scares people. But here's what the mainstream news didn't tell you. While the paper price of silver was falling, dealers were experiencing their biggest sales days ever. Physical demand was through the roof. In some countries, people were paying premiums well above the official price just to get their hands on actual metal. Think about that for a second. The official price says one thing, but people are willing to pay more than that price to own the real thing. That's like concert tickets being on sale for half price, while people are camping out for 3 days to buy them at full price. It makes no sense unless something deeper is going on. What actually happened was a perfect storm of events that forced a massive sell-off in the paper silver market. Trading exchanges suddenly increased something called margin requirements by more than a third overnight. Imagine playing poker with your friends, and suddenly the dealer announces that to stay in the hand, everyone has to triple their bet immediately. Most people can't do that. They're forced to fold even if they have good cards. That's essentially what happened. Thousands of traders were forced to sell their positions all at the same time, creating a cascade of selling pressure that had nothing to do with the actual value of silver itself. The fundamentals didn't change. The demand didn't disappear. The shortage didn't magically resolve. This was a technical event in the paper markets, not a reflection of silver's real-world supply and demand. And the timing of all this was fascinating. It happened right before Asian markets closed for the weekend, so they couldn't step in to stabilize anything. Major trading systems went offline at convenient times. False reports circulated about policy changes that were later confirmed to be incorrect. But by then, automated trading systems had already dumped billions in sell orders. Meanwhile, on the very same day all this chaos was happening, there was an announcement about a massive critical mineral stockpile that included silver. So the same week prices crashed. There's talk of the government potentially buying and storing huge amounts of physical silver in a market that's already short. If someone wanted to build a stockpile, wouldn't a fire sale price be rather convenient? Here's what makes this situation so compelling. The world is genuinely short of silver. We're using about 200 million more ounces every year than we're producing. Over the past 5 years, that adds up to roughly 1 billion ounces of deficit. You can't print silver like currency. You can't manufacture it in a laboratory. It exists in finite quantities in the ground, and extracting it takes years of planning and development. Silver mining production actually peaked back in 2016 and has been declining since then. The easiest deposits have already been mined over centuries. Only about a quarter of silver comes from dedicated silver mines. The rest comes as a byproduct when companies mine for other metals like gold or copper. So even if miners wanted to dramatically increase silver production, they can't just flip a switch. It doesn't work that way. Meanwhile, demand is accelerating in ways that most people don't realize. Silver isn't just for jewelry and coins anymore. It's being consumed in technology all around us, and the amounts are growing exponentially. Here's why that matters. Silver is the most electrically conductive metal on the planet. Better than copper, better than gold, better than anything else. When electricity flows through silver, it encounters less resistance than any other material. So when companies need maximum performance, when good enough isn't good enough, they use silver. Think about electric vehicles for a moment. A regular car uses a small amount of silver in its electronics. An electric vehicle uses roughly twice as much. But here's where it gets really interesting. The next generation of electric vehicles is coming soon with something called solid-state batteries. These batteries will provide over 600 miles of range and charge fully in about 9 minutes. They're safer, more efficient, and represent a massive technological leap forward. The catch is that each vehicle will require about 1 kilogram of silver. That's roughly 20 times more silver than current electric vehicles, and 40 times more than a regular car. At current prices, that's over $1,000 worth of silver in every single vehicle. Major manufacturers are already planning mass production of these vehicles starting in the next couple of years. When you multiply that silver requirement by millions of vehicles being produced globally, the numbers start to get astronomical. And this isn't speculation about some distant future technology. Production timelines are already announced. The transition is happening whether we're paying attention or not. Solar panels represent another massive source of growing silver demand. Each solar panel uses silver because it conducts the electrical current generated by sunlight more efficiently than any alternative. You could use cheaper materials, but when someone invests in solar panels, they want maximum efficiency. They want maximum power output, so they use silver. Solar installations in major markets are expected to grow significantly this year and in coming years. More panels mean more silver consumed, and once that silver is in a panel on someone's roof, it's essentially removed from the available supply. It's not easily recyclable like some other silver applications. Artificial intelligence and high-performance computing create additional demand that most people never consider. Data centers require advanced circuit boards. AI processing requires cutting-edge electronics. All of this consumes silver. As AI continues expanding across every industry and every country races to build more computing capacity, that demand only increases. Even military applications from drones to missiles to targeting systems require silver for their high-performance electronics. When performance is literally a matter of success or failure, organizations don't cut corners on materials. They use the best available, which is silver. So we have a situation where supply is constrained and declining while demand is accelerating from multiple directions simultaneously. Basic economics says that when demand exceeds supply, prices should rise. But silver has historically been undervalued relative to other precious metals, which creates an interesting opportunity. There's a relationship between gold and silver prices that has held relatively constant throughout history. Ancient civilizations valued silver at about 1/15 the price of gold. The Roman Empire used a 12-to-1 ratio. Even early American coinage laws established a 15-to-1 relationship. For most of the past century, the ratio has typically ranged between 40-to-1 and 80-to-1, with an average around 60-to-1. Right now, that ratio sits above 100-to-1. Either gold is extremely overvalued, or silver is significantly undervalued, or perhaps a bit of both. But historically speaking, silver appears cheap relative to gold. When that gap closes toward historical averages, it implies substantial price appreciation for silver. The recent volatility actually demonstrates something important about how these markets work. There are essentially two silver markets running in parallel. There's the physical market, where real metal changes hands, and there's the paper market, where contracts and promises trade back and forth. In the paper market, traders use leverage to control large positions with relatively small amounts of capital. When everything is moving in one direction, that leverage amplifies gains enormously. But when rules change suddenly, or prices move against positions, that same leverage forces rapid liquidation. That's what happened recently. Margin requirements increased, forcing over-leveraged positions to sell regardless of fundamentals. This creates spectacular volatility, but doesn't change the underlying supply and demand dynamics. This pattern has actually repeated throughout silver's history. Back in 1980, certain traders tried to corner the silver market, and prices spiked dramatically. Exchanges changed the rules, margin requirements increased, and prices crashed. In 2011, after the financial crisis, silver ran from the teens to nearly $50 an ounce. Exchanges raised margin requirements 5 times in 2 weeks, and prices fell by almost half. More recently, similar patterns emerged. Every time silver starts running hard, the same playbook appears. Margin requirements increase, leveraged positions get flushed out, prices drop sharply. Then eventually, the fundamental supply and demand dynamics reassert themselves, and prices recover. Understanding this pattern helps avoid panic during volatile periods. The disconnect between paper prices and physical demand during recent volatility was particularly telling. While paper prices were falling, physical dealers couldn't keep up with demand. People were paying premiums above the official price just to obtain actual metal. In some markets, those premiums reached $10 per ounce or more. That signal matters. It suggests that people who really understand silver markets see the recent price action as an opportunity rather than a reason to sell. They understand the difference between a technical event in leveraged paper markets and the genuine long-term value of physical metal. There's also the inflation consideration that can't be ignored. When currency loses purchasing power over time, hard assets like silver tend to maintain value better than cash. A house that cost $25,000 in the early 1970s costs many times that amount today. A car that costs $3,000 then costs 10 times that now. Movie tickets, groceries, everything costs dramatically more. That's the effect of inflation eroding currency value over decades. Silver provides some protection against that erosion because it can't be printed or created out of thin air. Its supply is constrained by physical reality. As currency supplies expand and purchasing power declines, commodities like silver typically adjust upward in price terms. But silver might be more than just an inflation hedge right now. Because of the supply deficit and accelerating industrial demand, there's a case that silver could outperform inflation significantly significantly. The safety net is that inflation should push prices higher naturally. The upside potential comes from supply and demand imbalances, creating additional price pressure beyond just inflation adjustments. Silver has also stood the test of time in ways that matter. It's been used as money for thousands of years across countless civilizations. It survived the Roman Empire's collapse, government crises, financial panics, wars, and every other kind of chaos humans have created. There's something reassuring about holding an asset that has maintained value through millennia of human history. Paper currencies come and go. Governments rise and fall. Financial systems change. But silver remains silver. Now, the volatility cuts both ways. Silver can drop substantially in short periods, as recent events demonstrated. Anyone considering silver needs to understand and accept that volatility. 30% moves aren't unusual. They're part of how this market functions. If that kind of price swing causes panic or stress, then perhaps silver isn't appropriate. There's no shame in choosing calmer investments that allow better sleep at night. But for those who can handle volatility and think long-term, that same volatility creates opportunities. Prices drop sharply due to technical events rather than fundamental changes. It potentially offers better entry points. The key is avoiding leverage and not risking money needed for immediate expenses. The recent events showed exactly what happens when traders use too much leverage. They can be forced to sell at the worst possible times, regardless of whether it makes sense fundamentally. Patient investors who own physical metal or unleveraged positions don't face those forced liquidations. They can ride out volatility and wait for fundamentals to reassert themselves. That patience is crucial. There's also an important distinction between physical silver and paper silver that recent events highlighted. Physical metal in hand is fundamentally different from a promise or contract. When push comes to shove, people were willing to pay premiums to own actual metal rather than trust paper claims. That premium tells you something about where real value resides. For those genuinely concerned about financial system stability or currency devaluation, physical ownership provides security that paper promises can't match. The trade-off is less liquidity and convenience, but that's the price of genuine security. Diversification remains important, regardless. Silver shouldn't be the only asset anyone holds. A balanced approach across different asset classes typically provides better risk-adjusted returns over time. Real estate, stocks, bonds, precious metals, perhaps other alternatives, all play different roles in a portfolio. The exact mix depends on individual circumstances, risk tolerance, and goals. But having some exposure to hard assets like silver provides balance that pure financial assets can't offer. The path forward for silver remains uncertain in terms of exact timing and price levels. Short-term, there could be continued volatility. Prices might test lower levels before turning higher, or they might stabilize and gradually climb. Nobody knows for certain, and anyone claiming to know exactly what happens next is selling something. What we can observe is that fundamental supply and demand dynamics haven't changed. The shortage is real. Industrial demand is growing. Production remains constrained. Those fundamentals eventually matter more than short-term technical events and paper markets. Historical patterns suggest that after these dramatic sell-offs, silver eventually recovers and continues higher. The 1980 crash took years to recover from because demand was primarily speculative. The 2011 crash also took time, but more recent corrections have recovered faster because industrial demand provides a genuine floor. The economy actually needs silver for technology. That's essential to modern life. That need doesn't disappear because traders got margin calls. If anything, that need intensifies as technology continues advancing and electrification accelerates globally. Looking at longer timeframes provides perspective that daily price action obscures. On multi-decade charts, what's happening now could represent a major breakout from patterns that formed over 40 or 50 years. If that interpretation is correct, we might be in early stages of a much larger move that plays out over years rather than months. That possibility makes current volatility look like noise rather than the main story. The recent chaos also revealed how these markets actually function versus how they're supposed to function in theory. The official narrative is always neat and simple. New policy appointment, markets react, prices fall. Done. Reality is messier. Margin requirement changes, system outages at convenient times, false information spreading, massive forced liquidation, all while physical demand surges. Understanding that complexity helps separate genuine signals from noise. It helps identify when price moves reflect fundamentals versus technical factors that eventually reverse. For those paying attention, recent events created potential opportunity rather than just risk. When prices fall sharply due to forced selling rather than changed fundamentals, that's traditionally when value investors get interested. They see assets on sale rather than assets to avoid. That contrarian perspective requires conviction and patience, but it's also how fortunes are made. Buying when others are forced to sell, selling when others are desperate to buy. The trick is, having the knowledge and confidence to act when others panic. Silver's role in the emerging technological landscape appears secure. Electric vehicles aren't going away. Solar energy continues expanding. Artificial intelligence requires more computing power, not less. All of these trends point towards sustained and growing industrial demand for silver. Unless someone discovers a substitute material that conducts electricity better than silver and costs less, that demand continues. So far, no such material exists. Silver remains the best option for high-performance applications. The geopolitical dimension adds another layer. Various countries are recognizing silver and other critical materials as strategic resources. When governments start building stockpiles of materials they deem essential for national security and economic competitiveness, that's a signal worth noting. It suggests that sophisticated institutional actors see long-term value and strategic importance. Their actions might be more informative than short-term price movements. Recent events separated those who understand silver markets from those who were just along for the ride. Panic sellers took losses. Physical buyers saw opportunity. Paper traders got margin calls. Patient holders stayed calm. That sorting process is healthy for markets long-term. It removes weak hands and concentrates holdings among those with stronger conviction and longer time horizons. That foundation supports more sustainable price appreciation. The bottom line is that silver presents a unique situation right now. A genuine supply-deficit meeting, accelerating demand, historical undervaluation relative to gold, technology trends that require increasing amounts of silver, volatility that creates entry opportunities for those who understand what they're looking at. None of this guarantees any particular outcome, but it creates a setup that deserves serious attention and consideration. The key is approaching it with knowledge rather than emotion, with patience rather than leverage, and with realistic expectations about volatility. Let's say do that might find that recent chaos created opportunity rather than just risk.